Hi everyone. In this video, we're going to be talking about Chapter 10 and specifically the depreciation piece of Chapter 10. So up until this point, we've been talking about long-lived assets and the cost to acquire them, to construct them, and to get them ready for use. So let's say we have a new bakery that we want to open because our current bakery is doing so great. So for the new location, we're going to go out, buy land, pay a realtor to help us do that, pay any legal fees, title fees, and then we're going to pay to construct a brand new building. We're going to pay an architect to design that building. A lot of expenditures, right? We're making a lot of payments to invest in our new bakery. So it really wouldn't be fair or ideal if we had to recognize all of these expenses up front. It would be millions and millions of dollars. And up front, we don't have any revenue. We have to get the business off the ground. We have to have a store, a storefront, before we can make any sales. And so ideally, what we would want is to say, okay, we've spent all this money now, but we're going to recognize the expenses over time because over time we're also generating revenue. And so that way we would match the expense of these assets to the revenue generated by the assets. And that's why in chapter 9, we talked about how with these long-lived assets, there are certain rules that allow us to capitalize the expenditures related to these assets. Capitalize means we recognize these expenditures as assets up front, and then later on we expense them out. Now in chapter 10, we are at the later on time period. We are ready to expense them out. The way we do that is through depreciation. So depreciation, this is going to be a cost concept, not a valuation concept. And that difference matters because when I say cost, I'm talking about historical cost. How much did it cost us to get the asset ready for use? When we're talking about valuation, we're talking about more current day, the market. If you were to sell it today, how much could you get for it? And we know that prices and costs change over time, so these are two pretty different numbers, cost versus fair value. So with depreciation, it's the process of taking the historical cost of these assets and then allocating it, separating it piece by piece, and expending it in a certain systematic way. And so we're going to have a couple of different methods that we'll talk about for how firms can depreciate their assets. So two related concepts is that when you're doing depreciation, when you are making the journal entry for it, you're going to have two accounts. One is going to be depreciation expense, and this is your current year expense, okay? It is for the current time period, it is for one fiscal year. So it's saying of the asset's total historical cost, the allocation, what is the allocation, the piece that you expense in this year? And because it's an expense, we are going to see it on our income statement. The credit in that journal entry is going to be accumulated depreciation, which is a contra asset. So this is our total depreciation of all time. So this is a running total. This is how much did we depreciate for this specific asset this year, last year, the year before that, total. And because it is an asset, specifically a contra asset, it's going to appear on our balance sheet. And then we have the formula for book value, which is cost, historical cost, minus accumulated depreciation. And this just captures the number of, how much of that asset's cost is still available to you to be depreciated, to be used up over time. So the reason why we do cost versus fair value is that we like book value and we like historical cost because it's more of a steady and fixed number. The amount you paid for the asset is the amount that you paid. There's no changing that. The fair value instead could fluctuate. It depends on a lot of factors, depends on the economy. The market price of something can fluctuate a lot more. And because it fluctuates, sometimes it's also hard to identify. You don't know. When you buy something, you have a receipt for the historical cost. Here's how much I paid. But fair value is speculative. You're guessing. Here's how much I think it would be worth today. All right, we'll get into depletion and impairment in the later parts of this chapter. So here's an example. These are screenshots from Deere and Company's 10K where they talk about their depreciation a little. They say that they use the straight line method. They give some more details about it. They also tell us about some updates, some hypotheticals, which I thought was really informative. They said, hypothetically, if the future market values decrease 10%, it would have material consequences. This would increase the company's depreciation by approximately $185 million. So they're being pretty transparent. They are sharing potential outcomes. If this happened, here is what the outcome on our financial statements would be. All right, so let's jump right into a couple methods of depreciation. The first one that we're going to talk about is the activity method. And the idea behind this one is that we're looking at proportions. So, how much of your asset have you used up based on a certain metric, whether that metric is miles or however many, I don't know, however many hats it can produce on the assembly line. Basically, the activity of that asset, how much activity has been done already versus how much can you get out of it in total. So this is making an assumption. It's saying that the asset gets used up not just over time, not the same amount every single year, but it gets used up and it should be expensed according to how much activity you have used it for. So we have the formula here, and let's do an example. Kahan Corporation owns delivery trucks, which are replaced after 100,000 miles. So this is basically saying that 100,000 is how much activity you can get. That is the maximum activity. After that, you replace the trucks. One truck has a cost of 20,000 and a salvage of 2,000, and it was driven 6,000 miles in the past year. What is the journal entry to record depreciation? So if we follow the formula above, we start off with the historical cost of 20,000. We subtract the salvage value, which is going to be $2,000. So how much you get after you dispose of the truck. And then we divide by the total estimated activity. So how much total activity will the trucks go through? The total is 100,000 miles. After they run 100,000 miles, they're done. We are replacing them. And lastly, we multiply by how much activity has already happened. So the metric for this and the metric for the estimated activity are going to be the same. Same metric, which in this case is miles. The truck has been driven 6,000 miles out of a total of 100,000. We multiply this out to get 1,080, and that is the depreciation for the year. So December 31st, we debit depreciation expense and we credit accumulated depreciation for the 1,080. Next, we have the straight line method. This is the simplest method. You're going to see it pretty often. And the idea is that depreciation should be the same amount every single year. It is an equal amount and it's a function of time. We depreciate for a given time period the same amount in every period. The formula, cost minus salvage, divided by the estimated useful life. So with Delray Incorporated, they purchase equipment that costs 10,000, has an estimated useful life of 20 years, and a salvage of 5,000. So what is the annual depreciation expense? So following that formula, we take our cost, 10,000, subtract salvage of 5,000, divide by estimated useful life, 20 years, and we get $250 of depreciation expense per year. So that's going to be the amount expensed every single year, year 1, year 2, year 3, until we are done depreciating. Next, we have a decreasing charge method. These are known as accelerated depreciation, and the idea behind this is that you're going to depreciate more early on. So if we have a graph where we say over time, what is the amount of depreciation? It could look something like this, right? Where depreciation is really high in the early years in year one, but then by the time you get to year five, depreciation is much lower. And you're making an assumption here. That's that you are going to use the asset much more early on in year one, two, than you are later on in year five, six. And because you're using it more, you want to match your use and your revenues and your expenses. So you're going to use it more, you're going to depreciate it more early on. So we're going to talk about two methods under this umbrella of accelerated depreciation. The first one is the sum of the year's digits method, and the formula is right here. So the numerator is the remaining years, so how many years of useful life are left. Denominator is sum of years' digits, and we'll go through that in a minute. And then we multiply by cost minus salvage, and another vocabulary word for that is the depreciation base. Okay, so in this example, we have Ezra Corporation installing a machine that costs $12,000, has an estimated useful life of 5 years, and a salvage of 2,000. What is the depreciation expense in 2027 when it's currently 2025? All right. So we'll do some upfront math and then we'll make a table. So for the upfront math, we'll check out what is the depreciation base, which is our cost minus salvage. 12,000 minus 2,000 equals 10,000. And then we're going to have the sum of years' digits. So when I say sum of years' digits, we're taking the years of useful life, which in this case is 5, and you're adding every number below it. So that means you start with 5 and you add 4, 3, 2, 1. If the useful years was 3, your sum of years' digits would be 3 plus 2 plus 1. If there were 6 years of useful life, your sum of years' digits would be 6 plus 5 plus 4 plus 3 plus 2 plus 1. It's just the years of useful life plus all the numbers below it. In this case, that adds up to 15. So in our table, we'll just do rows. So we have years of depreciation. It's 2025, then 2026, and then 2027. We need to figure out the remaining years in order to get to our fraction. So right here, remaining years over the sum of years' digits. This is our fraction. So that fraction times the depreciation base is going to give us the depreciation expense for the year. So in 2025, we have 5 years of useful life left. So our fraction is the remaining years left, 5, divided by the sum, so 15. And the depreciation base is 10,000. So that multiplies out to 3333. In 2026, we only have 4 years left because 1 year has already passed. So our fraction is 4 divided by 15 times the $10,000 base, which gives us 2667. And then lastly, we have 2027 where there are 3 years left. Our fraction is 3 over 15 times the 10,000 base gives us $2,000 of depreciation in that year. And you'll notice the trend over time where depreciation is decreasing from year to year because this is an accelerated method where we recognize more depreciation upfront. Another accelerated method is going to be the declining balance method. Similar idea, But now with the formula, we're going to use the book value of the asset, which means cost minus accumulated depreciation. And we're going to multiply it by the declining balance rate. So the rate is going to be a number times 1 over the useful life. And a note here that we can't depreciate forever. So depreciation is going to end when the book value is equal to the salvage value. So this is an important note. That means we have to check, we have to make sure that our book value is greater than or equal to salvage. That is a rule. Okay. So we have Ritchie Corporation installing a machine that cost $4,000, has an estimated useful life of 5 years, and a salvage of 2,000. So we're using the double declining balance to calculate depreciation for 2026. So to figure out our rate, because this is a double declining balance, we multiply by 2. That's what I meant by number. 2 is our number because it's double declining. That's kind of the standard one. You're really not going to see a triple, a quadruple, but in theory you could. So normally we have double declining 2 times 1 divided by a useful life of 5 years gives us 40% as our rate. So now we're going to make a table to calculate depreciation. We have the year, we have the beginning book value times the rate, which gives us depreciation expense. But remember our rule, book value has to be greater than salvage. So that means whenever we're depreciating, and this applies to all the methods, it's not just this one. Whenever we're depreciating, we have to make sure that we don't depreciate more than what we can. So that means we have to do a sanity check, and we have to check our ending book value. With that ending book value, we have to make sure that it is greater than or equal to salvage. So in this table, we have 2 years, 2025 and then 2026. In 2025, we start off with the beginning book value of 4,000. Because no depreciation has happened yet, it's the first year, that's the historical cost. We multiply by the rate of 40%, and our depreciation is 1,600. Whoops. So the ending book value, this is going to be our beginning book value minus depreciation. So in this case, that is the 4,000 minus the 1,600 gives us 2,400. And that 2,400, we need to make sure it is greater than or equal to salvage, which in this case is 2,000. So 2,400 is greater than 2,000. We are good to go. In 2026, our beginning book value is now 2,400 because that's how much we ended with in the year prior. That is what is on our books. The rate is still 40%, and so depreciation is 960. Again, we're going to make sure, can we actually depreciate 960? If we did, then our ending book balance would be 2,400, the beginning, minus the 960 of depreciation, which would give us 1,440. The problem here is that 1,440 is less than 2,000, so we are not allowed to do this. Nope, nope. This is less than salvage, and that is not allowed. So when this happens, you can set a limit where you're going to say our ending book value has to be 2,000. That is the minimum, that is the lowest it can be, which is equal to salvage. So that means we have to modify our depreciation expense. Our depreciation is that 2,400 beginning minus depreciation is equal to 2,000. So the depreciation can only be 400 for that year. And at this point, we have fully depreciated our asset, and there's nothing to depreciate later on. In 2027, there is $0 of depreciation. Lastly, there are some other methods of depreciation, especially for companies that have bulk assets. Sometimes it's easier to group them together and then to calculate a grouped depreciation expense. Depending on whether the assets are similar or different, a company can use a group method or a composite method, and here's just an example of that. All right, we will pick back up with the rest in class. Have a great weekend, drink a lot of water, and I will see you guys soon.